holding ratio would be 1. If I've got 100 in my checking account and I only want $50, the currency holding ratio would be a half. But I could have 100 in my deposit account and want to walk around with 200 in cash, in which case the currency holding ratio would be 2. Right? So that's all we're talking about. What is the relationship that we have between the currency that we want to hold and the size of our deposit accounts? So that's the currency holding ratio. Now keep in mind, this currency holding ratio is going to be determined by the public. Right? We get to decide what that ratio is. And it'll be some positive number. The second ratio that we have is our required reserve ratio. Again, this is the legal minimum that banks must hold as a share of their deposits. So we could just think of the dollar volume of required reserves divided by deposits. Right? This is going to be determined by the central bank. It could be 0, and in fact, in some countries it is 0, not in the United States, however. It's hard to imagine that it could ever be greater than 1. Can you require somebody to hold more reserves than they have in deposits? Can't think of that. But there have been a number of people, especially since the financial crisis, that have argued that one way to make banks safer is to have a required reserve ratio of 100%, or 1. And then finally, we have our excess reserve ratio, ER, which is the amount of excess reserves relative to deposits. Right? So the excess reserve ratio. This is going to be determined by commercial banks. How much do they want to hold? As I mentioned, and when the economy and the financial markets are operating normally, the rate of return on excess reserves is so low that there is no economic incentive to hold excess reserves. So in general, the excess reserve ratio should be 0. Notice I said should be, not is. Okay, so this is the currency holding ratio. As you can see, it's changed quite a bit, especially since the mid-1990s. So back here, not much change, a little growth there. But from 1995 to roughly the beginning of the recession, 2007, the currency holding ratio rose from a fairly low number of 0.4 to up to 1.2. Now, it actually turns out that most of this currency is being held outside the country. And it's primarily being held in $100 bills. So maybe you can figure out why outside the country people would want to have a lot of $100 bills. There's generally 2 reasons. One is you're worried about political stability in your own country. So you want to convert as much of your own wealth into dollars rather than keeping it tied up in your own currency. The second is you are engaging in large illegal transactions. And this is a good way to launder those cash flows. But then since the crisis, we've come down quite sharply. Now, we already looked at a currency chart, and we saw that since the crisis started, the currency holdings have gone way up. So if currency relative to deposits has come down, it must be that deposits went up even more than currency did, which in fact is true. Again, if you go back to our lecture on the quantity theory, you'll see what happened to M1 deposits. They went up quite sharply. One of the reasons is those deposits are government guaranteed. It's a safe way to hold liquid assets. You may not earn very much on them. In fact, I guarantee you won't earn very much on them. However, if your bank fails, the federal government will make sure that you don't lose your deposits. Okay? This is required reserves. And you can see big changes back here in the 80s, another big change in the early 90s, and something peculiar in here which I was not aware of, apparently in 2009. But you can see rarely does the required reserve ratio change. There's a lot of noise in there just because of deposit shifts. And it's, in round numbers, 10%. It's a little bit less than that because small banks don't have to hold as much as big banks. And here's our excess reserve ratio. Again, it doesn't look a whole lot different than what we saw before. Most of the time it's 0. Now it's almost 1.8. So let's figure out if we can see what this relationship is then between the money supply and the monetary base. Now we're going to go through some algebra here. This is very simple algebra, and I will never, ever ask you to replicate it, but I may ask you to think about the results of it. Not only may, I will. Okay, we can be more definitive about that. Okay, so the arithmetic is just to show you how we get from the beginning to what we're really interested in. Right? So our monetary base is reserves plus currency. Reserves are required reserves plus excess reserves. Right? So we can take the right-hand side here, do a substitution, we come down here. So the monetary base is simply required reserves plus excess reserves plus currency in circulation. Remember those ratios that we calculated? Well, here's required reserves, here's excess reserves, and here's currency holding. So do that substitution, come down here and simplify. Notice what we have then. The monetary base is a function of deposits, dependent upon what the required reserve ratio is, set by the government, excess reserves, determined by the central bank, and the currency holding ratio, determined by the public. Now, it turns out at this step, we actually don't want the monetary base. Let's look at an equation for deposits. So we just solve for deposits, and what do we see? Deposits equal the monetary base times this funny expression here. 1 divided by the sum of the required reserve ratio plus the excess reserve ratio plus the currency holding ratio. Now, think about what some of those values were. The excess reserve ratio is normally 0. The required reserve ratio, about 10%, 0.1. And the currency holding ratio, except for more recently, was actually fairly low. We started off at 0.4, now we're down around 0.8. So if we think about those kinds of values, 0.8 and 0.1 gives us 0.9. Notice the denominator is now less than 1. So this ratio then will be greater than 1. Deposits will be larger than the monetary base. So given sort of the usual or normal values for required reserve ratio, excess reserve ratio, and the currency holding ratio, we would expect that deposits would exceed the monetary base. Now, we need more. Because so far we have a relationship between deposits and the monetary base, but what we're looking for is a relationship between the money supply and the monetary base. But the money supply is nothing more than deposits plus currency. And currency is simply the currency holding ratio times deposits. Let's make this substitution over here. We now end up by simplifying that the money supply is equal to 1 plus the currency holding ratio times deposits. but we just calculated an expression for deposits on the previous slide. So we can take those, take this expression, push it into here, and we end up with this. The money supply equals 1 plus the currency holding ratio expression divided by the required reserve ratio plus the excess reserve ratio plus the currency holding ratio. That's now our ratio in between times the size of the monetary base. The central bank controls the monetary base absolutely through open market operations. By controlling this, running it through the money multiplier, it can now determine what the money supply should be. Okay. Yes? No, the required reserve ratio is 0.1, 10%. Okay? Okay. So this then becomes our expression for the money multiplier. 1 plus currency holding ratio divided by the required reserve ratio plus the excess reserve ratio plus the currency holding ratio. Now look at that expression and remember that the excess reserve ratio is usually 0. And if the required reserve ratio is less than 1, that is, we have a fractional reserve banking system, then the denominator is going to be smaller than the numerator, so the value of the money multiplier will also be greater than 1. Right? Even if the excess reserve ratio is not 0, as long as the sum of the required reserve ratio and the excess reserve ratio is less than 1, the money multiplier will end up being greater than 1. Change the monetary base, you'll get a bigger change in the money supply. Okay? Again, the central bank can control the monetary base directly. That's our exogenous variable. In order to control the money supply, they have to think about what's happening to the currency holding ratio and what's happening to the excess reserve ratio. Most of the time, if this is 0, they only have one thing to worry about. But when banks start to change their behavior, it gives them more to worry about. Okay, this also tells us, by the way, let's go back to this chart. This also tells us why some people were very concerned by the sharp increase in the monetary base back in 2008, again in 2010, and again in at the end of 2012. Right? If you get big increases in the monetary base, unless it's offset in here, you're going to end up with big increases in the money supply. If that happens, then you also end up with, according to the quantity theory of money, big increases in inflation. Now, we have this thing called quantitative easing. Okay, so quantitative easing is really a term that the media likes, but economists don't. So economists generally refer to what the media refers to as quantitative easing as large-scale asset purchases, or LSAPs. Right? So these are large-scale, meaning these are big, and they're asset purchases. These asset purchases are done through open market operations just like regular open market operations themselves. What distinguishes LSAPs or quantitative easing from our traditional open market operations is two things. One is the size of the operation. Generally, LSAPs are much, much bigger. The second is the assets that are being purchased. Traditional open market operations generally involve relatively short-run government securities. LSAPs generally refer to long-run or long-dated securities, typically government, but not exclusively. As I mentioned earlier, the Federal Reserve also does mortgage-backed securities and agency securities. But they're 5-year, 10-year, 15-year maturities. So that's what's involved there. What's it intended to do is to push down intermediate to long-term interest rates. Remember, in our normal open market operations, we're dealing with a Fed funds rate, federal funds rate, a short-term interest rate. But we might be able to drive down the short-term rate without necessarily having an effect on the long rate. So quantitative easing or LSAPs are generally meant to try to drive down long-term interest rates, the interest rates at which businesses borrow at. Now, that could be beneficial for the overall economy. It does, without a doubt, increase the size of the bank's balance sheet, as we've seen. And the risk is that it can lead to sharply higher inflation if nothing has happened to the money multiplier or the velocity of money. So here's the monetary base, QE1, QE2, and QE3. So we're up almost 500% on the monetary base. We're up less than 60% on the money supply. Why? Because the money multiplier has gone from 9 to under 3. It's fallen by 2/3. I'll let you look at the rest of the charts and see if you can figure out what's going on. Have a nice weekend. Don't forget, problem set number 4 is already posted and due on Tuesday.